So Firoz, we've already spoken about short-term capital gains, but like somebody said, death and taxes are the only certainty, and I guess that's what someone was thinking when LTCG or the long-term capital gains was reintroduced. So let's talk about that.
Yes, I think, Sumaira, long-term capital gains is going to be an integral part of your investing life. So understanding it in detail, I think you're duty-bound to do that as an investor.
All right, so before we get talking about long-term capital gains, let's understand what long-term really is. For equity, it's a year. For real estate, it's 2 years. For debt mutual funds and gold, it's 3 years.
Now that you've told what the definition of this word long-term is, it's also important to understand what's the extent of taxation. It is not constant across all asset classes. Equity is 10%. For real estate and debt and gold, all the other three is 20% with the other charges like cess.
Right, but let's not forget the benefit of indexation as well, right?
Right, Sumaira. Indexation is something which we all need to understand when it comes to long-term capital gains. Indexation is nothing but the concept of a tax discount to the extent of inflation or mehengai as we call it. For example, if I've invested 100 rupees in a debt mutual fund for 3 years and the 100 rupees has transformed itself to 130 rupees, the gain which we have in the long-term category is 30 rupees. The income tax department tells you that whatever was the inflation for that period, let's assume cumulatively it was 10 rupees. So you have to not pay tax on the long-term category for the entire 30. You will have to only pay it for the differential, which is 30 minus 10, which is 20 rupees.
Okay, so that's indexation, but let's get back also to equity mutual funds. Investors can now offset the equity losses as well, right?
Right, Sumaira, again a very, very important point to remember. For all these years, almost 13-14 years, there was no long-term capital gains on equity. Now there is long-term capital gain. In turn, the losses you make in the long-term category are now useful. They can be carried forward for the subsequent 8 financial years and can be set off against all long-term capital gains from other assets as well. If you've made money in real estate but lost money in equity, both in the long-term category, they can be set off.
Retail investors must remember that if you're investing via SIP, every single installment of your SIP will have to complete and be eligible for long-term capital gains individually. You cannot calculate it just from the start of your SIP.
One more good news, Sumaira, for people who actually invest for the long term. If you have made capital gains on the long-term head in real estate, you also have a provision to reinvest it back in a residential property and get a tax exemption on that under Section 54.
And that's not the only good news. Every year, 1 lakh rupees of booked gains on equity and equity mutual funds are exempt from long-term capital gains for every individual.
Now we know, Sumaira, that it's not just about understanding the return of your investment, but also the tax implication of that investment.
A lot of funds actually hold some papers in very, very high concentration, right? So if one company goes bad, all the schemes of that fund would see a domino effect.
What happens is a specific asset management company across its different schemes puts the same bond in. And that's why when there's a default, all the schemes related to that specific asset management company suffer a dent in the NAV.